Hello, friends. 3 changes currently affecting American seniors here in June 2026 represent genuine financial victories, and most folks have either missed hearing about all of them or have heard mention without grasping the precise steps required to secure the complete benefit. Informative. I want to go through each one plainly, spell out exactly who benefits, what the dollar figure looks like, and what action you must take today to ensure you are not leaving anything on the table. My name is Linda Foster. I have served 12 years as a credentialed retirement planner, and these 3 changes are what I am discussing with every client right now because the combination of them for the right household can produce thousands of dollars annually in net income permanently. Excited? Change number 1, the Social Security COLA boost, and how to confirm you are collecting the full sum. In January 2026, Social Security payments climbed by 2.8% for every beneficiary. For the typical retiree collecting $2,015 monthly, that bump came to roughly $56 a month, lifting the average check to about $2,071. That is the headline figure. But here is the truth that most folks discovered when their January deposit landed. The net gain was meaningfully less than $56 for most Medicare-enrolled seniors because the Medicare Part B premium also climbed at the same time. The Part B premium grew from $185 monthly in 2025 to $202.90 in 2026, a jump of $17.90. For a senior collecting exactly the average benefit, the net gain after the Medicare premium hike came to roughly $38.10, not $56. For seniors who additionally pay IRMAA surcharges on Medicare because their income surpassed certain limits 2 years back, the net gain may have been even tinier, or in some instances the surcharge hike may have partially or completely wiped out the COLA. The action step from this change is precise. Review your actual January 2026 deposit figure and stack it against your December 2025 deposit. The gap shows you your true net gain. If your net gain was meaningfully tinier than expected, or if you are paying an IRMAA surcharge tied to 2024 income that no longer mirrors your present financial picture because you retired or your income dropped, you may be able to reclaim some of that lost ground. For anyone paying an IRMAA surcharge tied to higher prior year income, Form SSA 44 is offered at ssa.gov and lets you report a life-changing event, retirement included, and have Medicare reset your premium based on present income. Removing a Tier 1 IRMAA surcharge reclaims $81.10 monthly. Removing a Tier 2 surcharge reclaims $222.40 monthly. Those sums attached to your net Social Security deposit permanently are meaningful for any senior on a fixed income. That is change number 1. Change number 2, the senior bonus deduction and the refund many seniors are still expecting. The One Big Beautiful Bill Act of 2025 established an extra federal tax deduction of $6,000 for each individual 65 or above, or $12,000 for married couples where both are over 65. This deduction applies to the 2025 tax year, the return most seniors submitted earlier this spring. Per Treasury Secretary Scott Bessent, Trump's Working Families tax cuts brought historic tax relief to over 35 million seniors. The senior bonus deduction is the heart of that relief for retirees. The deduction shrinks your taxable income. For a single senior in the 22% federal tax bracket, $6,000 of added deduction yields $1,320 in additional tax savings. For a married couple where both are over 65 in the same bracket, $12,000 of deduction yields $2,640 in tax savings. For seniors with more modest earnings whose taxable income after the standard deduction and the existing senior add-on was already minimal, the senior bonus deduction may have driven their 2025 federal tax liability down to zero, turning every dollar of federal income tax withheld from their Social Security check throughout 2025 into a recoverable refund. Here is the June 2026 specific concern. The 2025 tax filing cutoff was April 15th. Most seniors have already submitted, but a notable number filed without the senior bonus deduction being properly applied, either because their preparer was not yet completely up to speed on the new law or because basic tax software failed to flag the change. If you submitted your 2025 return and are uncertain whether the deduction shows up, reach out to your preparer and ask specifically whether the enhanced senior deduction of $6,000 or $12,000 is reflected on your return. If it was overlooked, an amended return on Form 1040-X reclaims the refund. The cutoff to amend a 2025 return is April 15, 2029, so there is time, but each month you delay is a month the refund is not in your account. Furthermore, if you are presently having federal income tax withheld from your Social Security check using the W-4V form, recompute your true 2026 tax liability after applying the senior bonus deduction. If the deduction trims your liability to near zero, halting the withholding by submitting a new W-4V returns that money to your monthly deposit going forward. That is change number 2. Change number 3, the Medicare Part D out-of-pocket cap and why June is when it counts most. Beginning in 2025 and carrying into 2026, every Medicare Part D prescription drug plan has a firm annual cap on out-of-pocket outlays. In 2026, that cap stands at $2,100. After you have spent $2,100 out of pocket on covered Part D drugs throughout the calendar year, your cost for covered medications falls to zero for the balance of the year. This counts among the most consequential improvements to Medicare drug coverage in decades. Before the cap existed, seniors taking medications for cancer, diabetes, heart disease, or autoimmune disorders might spend $8,000, $10,000 or more annually on medications. That exposure is now capped at $2,100. Here is why June particularly counts. The cap resets each January 1st. Seniors who take consistent medications, particularly those with pricier prescriptions, frequently hit the cap by late spring or early summer. If you have been paying for medications since January, June is the month when many seniors are nearing or have already passed the $2,100 mark. Reach out to your Part D plan this week and ask for your year-to-date out-of-pocket spending total. Most plans also display this in the member portal. If you have already spent $2,100 on covered drugs this year, every covered prescription you fill for the balance of 2026 should cost you nothing at the pharmacy. If the pharmacy is still charging you after you have passed the cap, phone your plan immediately. If you have not yet hit the cap, but you are on medications that will bring you near it by year-end, October is the moment to use Medicare's Plan Finder at medicare.gov to weigh Part D plans for 2027 against your specific drug list. The plan that runs cheapest for your specific medications may not be the one carrying the lowest monthly premium. And if your income falls below roughly $22,000 as a single person or $30,000 as a couple, the Extra Help program through the Social Security Administration may eliminate most of your drug costs entirely. Apply through ssa.gov or by phoning 1-800-772-1213. That is change number 3. Let me wrap up by tying all 3 changes to the one practical step that counts most right now. Review 3 numbers this week. Your actual January 2026 Social Security deposit measured against December 2025 to grasp your real net COLA. Your 2025 tax return to verify the senior bonus deduction was applied, and your year-to-date Part D spending to gauge where you stand against the $2,100 cap. 3 numbers, 30 minutes, possibly hundreds to thousands of dollars in captured benefits that are yours by right and by law. Pass this video along to one senior in your life who has not reviewed any of these 3 numbers since January. I will see you in the next one. Let me dig deeper into each of the 3 changes because the practical specifics decide whether you actually claim the benefit or leave it behind. On change number 1, the COLA and IRMA interaction. I want to tackle the specific scenario of seniors who left work in 2023 or 2024 and are paying surcharges tied to their final working year income. Medicare applies a 2-year look back. Your 2026 premiums hinge on your 2024 tax return. A senior who retired in mid-2024 and posted a 2024 income of $140,000 from their final months of employment is potentially paying a Tier 2 IRMAA surcharge of $222.40 monthly in 2026 tied to income they stopped earning 18 months back. The Form SSA-44 process asks you to pinpoint the life-changing event, which is work cessation or reduction, and supply documentation of your retirement date and present income. Acceptable documentation includes your final pay stub, a letter from your former employer verifying separation, your pension benefit statement, or your latest tax return reflecting your present income level. Once the SSA processes your SSA-44, they reset your Medicare premium based on the income information you submitted instead of the 2024 tax return figure. The new premium kicks in typically within 60 to 90 days of submission. Each month between now and when the recalculation kicks in, you keep paying the surcharge. This is why submitting promptly counts. I want to specifically tackle one widespread misconception about the IRMAA surcharge. Some seniors believe that once they submitted their 2025 tax return reflecting lower retirement income, Medicare would automatically reset their 2026 premiums. This is wrong. The 2-year look back means your 2025 return will shape your 2027 premiums, not your 2026 premiums. The SSA-44 is the sole mechanism to request recalculation before the standard 2-year cycle would produce the adjustment. On change number 2, the senior bonus deduction, I want to tackle the interaction with the Social Security taxation thresholds because this is where the deduction generates extra value beyond its face amount. The Social Security taxation formula computes your combined income as your adjusted gross income plus non-taxable interest plus half of your total Social Security benefits. If this combined income lands below $25,000 for a single filer or $32,000 for a married couple, none of your Social Security is taxable. The senior bonus deduction trims your adjusted gross income. For a single senior whose combined income absent, the deduction is $27,000. The $6,000 deduction trims their AGI by $6,000, bringing combined income to $21,000. They have dropped below the $25,000 threshold. Their Social Security is now completely tax-free. In this case, the financial gain of the senior bonus deduction is not merely the direct tax on the $6,000. It is also the tax savings on whichever slice of Social Security was previously taxable. If this senior was paying tax on $4,000 of Social Security at 22%, the threshold crossing wipes out $880 additional dollars in tax. The full benefit of the $6,000 deduction is $1,320 direct plus $880, Social Security totaling $2,200, considerably more than the face value computation of the deduction alone. This multiplier effect is why grasping the complete interaction of all income items is so much more valuable than examining any single number in isolation. On change number 3, the Part D cap, I want to tackle the specific scenario of seniors who take expensive specialty medications, because these are the people for whom the cap delivers the most dramatic impact. Before the $2,100 cap existed, seniors taking specialty medications for conditions such as rheumatoid arthritis, multiple sclerosis, Crohn's disease, or certain cancer treatments confronted catastrophic out-of-pocket drug bills each year. A single specialty medication might run several hundred per month in cost sharing, generating several thousand in annual out-of-pocket costs. Under the $2,100 cap, a senior taking one of these medications who reaches $2,100 in total out-of-pocket spending by, say, April pays nothing for all covered medications from April through December. That is 9 months of medication at zero cost. The critical action for this group is to verify their Part D plan covers their specific specialty medication. Part D formularies, the roster of covered drugs, shift each year. If a medication is missing from the formulary, it does not count toward the out-of-pocket cap and may demand a separate prior authorization process. Reviewing the formulary for your specific medications during the October open enrollment window ensures you are in a plan that covers what you need. Also worth grasping for higher cost medication users, the manufacturer assistance programs that supplied additional discounts before the cap existed may now interact differently with the Part D structure. Some pharmaceutical manufacturers no longer offer copay cards or patient assistance for commercially insured patients because the cap eases financial need. If you were getting manufacturer assistance in prior years and that assistance has shifted, grasping how the new cap structure shapes your total costs is worth a discussion with your pharmacist or plan. Let me also tackle the specific scenario of seniors who are nearing Medicare eligibility for the first time in 2026, because the 3 changes I outlined apply to them from their very first day of coverage. If you reach 65 in 2026 and are signing up for Medicare for the first time, the $2,100 Part D cap applies to you from the very first day of your Part D coverage. You do not need to have been on Medicare in prior years to gain. The senior bonus deduction applies to your 2025 and 2026 tax returns, regardless of when you signed up for Medicare. And grasping the IRMAA structure from your first year of Medicare enrollment heads off the common surprise of stumbling onto a surcharge after the fact. For new Medicare enrollees, the choice of which Part D plan to pick is worth investing an hour on Medicare's Plan Finder at medicare.gov. Entering your specific medications generates a ranked list of plans by total projected annual cost, encompassing both premiums and drug costs. The plan with the lowest monthly premium is often not the plan with the lowest total annual cost for a given drug list. The Plan Finder makes this comparison instantly visible. One final point that ties all 3 changes together. These benefits all demand that you know they exist and that you take a specific action. The COLA showed up automatically, but the IRMAA recalculation requires you to submit the SSA 44. The senior bonus deduction is offered on your tax return, but only if the preparer or software applied it properly. The Part D cap applies to covered drugs automatically, but knowing when you have hit it requires monitoring your year-to-date spending. None of these benefits sends you a notification when you are due more money. The notification is this video. The action is yours to take. I will see you in the next one. Let me tackle several additional dimensions of these three changes that are particularly pertinent for specific groups of seniors. On the COLA and net income picture, I want to tackle the situation of seniors who are collecting Social Security disability insurance instead of retirement benefits. The 2.8% COLA applies equally to SSDI beneficiaries. The same Medicare premium dynamics apply, and the same IRMA rules apply if income triggers a surcharge for SSDI beneficiaries who have not yet shifted to retirement benefits at full retirement age. Grasping that the COLA applies to their current benefit and that the net gain is trimmed by the Medicare premium hike is equally important. Furthermore, for SSI beneficiaries, the 2026 COLA applied to the federal SSI ceiling as well. The federal SSI ceiling for an individual in 2026 is $967 monthly. For a couple, it is $1,450 monthly. SSI beneficiaries who additionally collect a small Social Security benefit or have other income sources need to grasp how the COLA interacts with the SSI income calculation. Each dollar of Social Security income above certain disregards trims SSI by 75 cents. Grasping your specific income mix and how the COLA shapes your total monthly income from all sources is worth a phone call to the Social Security Administration if you receive both SSI and Social Security. On the senior bonus deduction, I want to tackle the specific situation of seniors who use tax preparation services at major chains versus those who use independent preparers or CPAs. The major tax preparation chains refreshed their software to mirror the senior bonus deduction for 2025 returns. However, the quality of the explanation provided to clients about this deduction differed significantly across chains and individual preparers. Some clients received a clear walkthrough of the new deduction and its value. Others had it applied without any discussion, and a smaller number had it overlooked entirely, particularly in early season filings finished before preparers had completely absorbed the new law. If you used a major chain or a storefront preparer for your 2025 return and you did not receive any specific walkthrough about a new $6,000 or $12,000 deduction, that is worth circling back on. Phone the same office and ask whether the senior bonus deduction was applied to your return. If they say they are unfamiliar with that deduction by name, ask them to examine your Form 1040 and tell you what the deduction amounts are on the relevant lines. For seniors who submit their own returns using tax software, the deduction should pop up automatically when your date of birth is properly entered and the software has been refreshed. If you used an older version of software that was not refreshed before you submitted, the deduction may have been overlooked. Again, reviewing the relevant lines on your submitted return and amending if necessary is the action. I also want to tackle the 4-year window for the senior bonus deduction specifically because this opens up a planning opportunity that is particularly pertinent for higher income seniors who are at or above the income threshold where the deduction phases out. The deduction phases out at 6% per dollar above $75,000 of modified adjusted gross income for single filers and $150,000 for couples. At roughly $150,000 for a single filer, the deduction has phased out entirely. For couples, it phases out at roughly $350,000. For seniors near the phase-out boundary, the years 2025 through 2028 mark a specific window in which income management can safeguard the full deduction. Strategies that shrink MAGI below the threshold, encompassing qualified charitable distributions from IRA accounts, timing of capital gains realizations, and management of discretionary IRA withdrawals, can safeguard some or all of the deduction in years where income might otherwise surpass the threshold. For a senior whose income typically lands at $80,000 and who has some flexibility in the timing of IRA withdrawals or investment income, keeping income beneath $75,000 in 2026 through 2028 to claim the full $6,000 deduction yields $1,320 each year in tax savings, or $3,960 across the 3 remaining years of the deduction window. The planning discussion with a tax professional to accomplish this is worth holding before the end of each calendar year. On the Part D cap, I want to tackle the interaction with Medicare Advantage plans, specifically because a meaningful number of seniors receive their drug coverage through a Medicare Advantage plan with drug coverage instead of a standalone Part D plan. The $2,100 out-of-pocket cap applies to Medicare Advantage plans with drug coverage as well as standalone Part D plans. However, Medicare Advantage plans can carry their own cost-sharing structures for drugs that differ from standalone Part D plans, and how costs billed toward the cap may differ depending on the plan design. For seniors in Medicare Advantage plans, verifying with your plan how costs billed toward the $2,100 cap and what your year-to-date spending is requires reaching out to your specific plan instead of reviewing the standalone Part D portal. Many Medicare Advantage plans operate member portals that show year-to-date drug spending. Your member card or the back of your plan document includes the member services number. Also worth noting for Medicare Advantage members, the annual open enrollment from October 15th through December 7th lets you shift from a Medicare Advantage plan to Original Medicare with a standalone Part D plan, or to swap between Medicare Advantage plans. If your current plan's drug coverage is not satisfying your needs, the October window is when you can change. Using the Medicare Plan Finder during that window to weigh total projected annual costs, encompassing drug costs, for your specific medications helps determine whether a different plan structure would serve you better in 2027. Let me pull the complete June 2026 picture together with the specific action checklist I want you to finish before this month closes out. First, weigh your January 2026 Social Security deposit against your December 2025 deposit. Note the actual net gain. If you are paying an IRMAA surcharge and your income has dropped significantly since 2024, download Form SSA 44 from ssa.gov and start the recalculation process. Second, verify that your 2025 federal tax return incorporated the senior bonus deduction of $6,000 if you are single and over 65, or $12,000 if you and your spouse are both over 65. If it was absent, reach out to your preparer or get ready to submit Form 1040-X. If you are presently withholding federal income tax from your Social Security check, recompute whether your true 2026 liability after the deduction justifies the current withholding rate. Third, reach out to your Part D plan or review your member portal for your year-to-date out-of-pocket drug spending. If you have reached $2,100, verify that your pharmacy is not charging you for covered medications. If you have not reached the cap but are on medications that will bring you near, circle October 15th on your calendar as the kickoff of open enrollment to weigh plans for 2027. These 3 actions are specific, time-bounded, and directly linked to money that is either yours already or that you can claim through a single form or a single phone call. The June timing counts because the Part D cap progress review is most pertinent mid-year. The IRMAA recalculation saves you money for every remaining month of 2026, and the senior bonus deduction refund from an amended return arrives faster if you submit the amendment sooner. The 3 changes are wins. Claiming them fully demands knowing the specific action each one requires. I will see you in the next.